Hi friends, in the last video we have covered the difference various source of funds and we have covered two of them, that is equity and debentures. Equity, the major difference between equity and debentures. Equity is a fund which is raised and which will be repayable only on the time of liquidation or when we pay dividend annually. That is at the company discretion. There is no mandated distribution of profit. So the risk in risk of distribution is lesser than equity. However, it is more costlier because equity shareholders expect more than any other funds because they are taking the risk. If the company goes into loss, then they will be the one who get the money at the end, but they will get the full residual value that is available. The major difference in equity compared to debentures is debentures will get a fixed amount as interest and principal repayment, and this amount is receivable even if entity is making loss or entity doesn't make profit. So there is a mandatory requirement as per the agreement of debenture holders to make payment to the debenture holders. So it is advantage of debenture holders. It is a interest is a tax deductible expense. So if entity makes profit of 100 rupees and they have to pay 10 rupees debenture interest, they need to pay tax only for rupees 90. So that is the advantage of debenture. Problem is they have to pay the interest and principal repayment even if there is entity is unable to make any profit or entity is making losses. So even in the bad times, debenture holders are required to be paid. That is a major difference between equity and debentures. We have covered this in the last video also. Now I want to cover various forms of bank funding. Because commercial banks plays a very important role in funding to business. Why commercial banks raising fund from equity holder and debentures are comparatively more difficult than raising from banks. Banks give do assessment of requirement of fund and provide funding much more faster and at a lower cost than debenture holders and equity funds. That is one reason why every company approaches banks for funding. Banks funding can be broadly classified into fund-based limit and non-fund-based limit. Fund-based limit is where there is an outflow of fund from the banks. So suppose uh, there are facilities like cash credit, OD, terminal, all these funds. Bank is paying actual money to the customer, to the beneficiary. Whereas non-fund based facility, banks don't give money. Instead, bank gives a guarantee. Bank gives a guarantee to the other party. We'll cover each one of this facility in detail now because this is anyway part of the syllabus, even though not part of this chapter. So I will cover this now once and again also while going to the respective chapter. So first important facility is cash credit and overdraft. I will cover both of them together because both of them have so many similarities. Cash credit, overdraft, term loan, working capital term loan, purchase bill discounting or purchase bill and discounting. All these are working capital. All these are fund-based facility, meaning actual fund is going out from the bank and expected to repay. So that is fund-based facility. So the return it mostly is interest, and interest is calculated on interest will be calculated on the capital that is being gone out. So I will first cover two major facility. In this cash credit, overdraft, working capital term loan, bill discounting, all these are working capital facility. Working capital facility means these are for short-term requirement. Before understanding what is working capital, we need to understand what is working capital requirement. For that, I want to cover what is cycle, business cycle. Business cycle I can explain it here. You should, yes. So when a business starts, they need to buy raw materials. For purchase of raw materials, yes, for purchase of raw material, they have options. They can either purchase by paying full money, or they can purchase by credit, means they can pay the money later. Suppose, so there are two options: purchase in cash, purchase in credit. Okay. Oh, sorry. Extremely sorry. Yes, this is the one. How to actually, I'm not familiar with Google Sheet, so that's the reason I feel little difficulty in using this. Yes, this is the one I wanted. So they have, after this raw material purchase, these they need to process these raw materials. Correct, now? To process these raw materials, there is a stock will be converted as work in progress. I need to add arrow mark. Actually, I don't know the process. So instead of cycle, I'll put into step 1. Then I will cover here step. Yes. So that is a processing. I'm covering as a manufacturing entity. The service entity will be different. I will be covering another example later. So these raw materials will be processed. For processing raw materials, they will have further expenses. Plus, there will be some processing expenses, correct, no? Also, they need to hold this work in progress inventory. That takes time for processing. So holding period is there. Holding period of WAP. Once this is finished, then they will when the work in progress is completed, when they process the materials, this will become finished goods. Whether we'll be able to sell goods on the same day when the goods are processed? No. It will take some time. We need to hold the inventory. Hold finished. Correct now. So we need to hold the finished goods. And after holding this finished goods, we may find out customers. So after finding out customers, we have to sell the goods. There are two possibilities. We can sell the goods on cash, we can sell the goods on credit. Means we can sell the goods by having cash upfront, or we can sell the goods, but the customer will not give us cash upfront, they will take some time. Sale of goods, it can be on cash, meaning I sell the goods upfront and get the cash upfront, or I can also sell on credit. So this is a cycle. This is a cycle that normal business follows. First, raw materials will be purchased either in cash or in credit. Then this will be what you call processed. Processing of raw materials will be done. 1 minute, please. Image. Right, this is what I did. Let me see whether I can paste in this one. I can't do that. I can't even add symbols. I'm what I call familiar in using Microsoft Excel over Google Sheet, but it is not free software, so I don't have it in my personal laptop. So that is the reason I'm using Google Sheet. Problem is many symbols are not visible. I need to add, say like I need to add arrow mark. All these things are not visible here. That is the reason for taking time. So this cycle is understood. First step is purchase of raw materials. Purchase can be done in cash or in credit. So suppose it is purchasing credits. I need to repay the money in 30 days. And processing, it takes, for processing it takes around say like 60 days, because there are a lot of processing activities involved. So like say it's taking 60 days. Then finished goods. Finished goods also we are unable to sell in the same day. We may have to hold it for like 30 days. And suppose we are selling, it can be on cash or in credit. If you're selling on credit, means if you are selling and the other party takes time for repaying, that also takes, say like they take 30 days. So in aggregate, we have time. Since we're purchasing, first step, when we're purchasing on credit, we have to pay them after 30 days only. So that is a time that we get. Balance all time that we lose, means processing time we lose. Finished goods time we are incurring, so this time we had to lose. And silent credit means if a debtors period is also time that we lose. So in summary, debtors days takes 30 days. Inventory holding ash, WIP and finished goods. How much it takes? 30 days here as finished goods and 60 days here as WIP. So it is around 90 days, 60 plus 30, 90 days. So this is the total period taken as what you call for processing. So this much period is normally taken for processing and goods. Debtors plus inventory holding period. How much it is? 90 plus 30 is equal to 120 days. Correct. So, but we have one advantage here. We need not pay the money upfront. We can have 30 days time for paying to creditors. That is creditor days. Creditor days is how much? 30 days. So, net working capital days is 90 days. So, when bank funds when banks fund for working capital, bank funds after understanding the business cycle, means how much time how much debt credit period they are getting, how much credit period they have to give to the customers, what is the inventory holding period. These things they will understand. What is the processing period they will understand, and they do funding. So for this, normally bank provides multiple facilities. One is cash credit or overdraft. What is the difference between cash credit and overdraft? Both cash credit and overdraft is for funding this working capital gap of 90 days. The only difference between cash and the banks, one important thing, banks won't fund for entire 90 days. Banks will fund after ensuring some promoters margin. As per the normal custom, banks will fund around 75% of this working capital gap, and 25% of working capital gap will be funded by promoter using its own funds. Let me put in quantitative values. This is days. This is value. Suppose they purchase raw materials for rupees 10,000. So they have got credit period 10,000 rupees, 10,000 rupees, meaning that is the inventory holding. That is the inventory that they hold now, and they get for 30 days. This inventory, they are taking time both as finished goods and in the processing period. So inventory value after this processing, when they purchase inventory, it will be the liability side. In the asset side, this part will be showing as inventory. Inventory, this 10,000 rupees will be showing at a little bit higher value because this inventory will be, say, like, will be processed, meaning some value addition will be there. So this value addition, when since the value addition happens, say like it will be for 12,000 rupees. This 12,000 rupees inventory, some portion will be sold out. So the cost of inventory that has been sold out, say like, is half of this inventory, 6,000 rupees. And the 6,000 rupees inventory, they will be selling, say like, for not 6,000 rupees, they will be selling for a higher price, like some 8,000 rupees. Okay. So balance inventory in hand how much it is? Balance inventory in hand is around 6,000 rupees. So this is the opening inventory, both as processing as well as finished goods, is 12,000 rupees. On this, they have sold some inventory. This amount is actually cost of good sold. Yes. So balance inventory hand is 6,000 rupees. So I'm putting this in quantitative figures. Debtors, they have 8,000 rupees. I need to reduce the screen size so that it is visible for everyone. How to do that? Here it is. Okay, leave it. I will find it out later. As of now, I will avoid these unnecessary columns, and then I can. That is better. So yes. So here in sorry, yeah, inventory we are holding for 8,000 rupees. Correct, now 8,000 rupees are holding inventory. Sorry, oh, debtors days is 8,000 means they're selling goods for 8,000 rupees, and that is they need to hold. They will get the money after 30 days only. Inventory value we have calculated is 6,000 rupees. After selling 6,000 rupees inventory, balance 6,000 rupees inventory they hold. So total inventory plus debtors is around 14,000. Creditors, how much is creditors? We have calculated creditors as 10,000 rupees. So balance that we are having is 4,000 rupees. This 4,000 rupees, whether bank will fund 100% of 4,000 rupees? No. Bank will fund only, say like, mostly it will be like 25% will be promoter's contribution. Balance will be funded by banks. So promoter has to contribute around 25%, and the bank will fund the balance portion, which is 3,000 rupees. This is funded by multiple facilities like cash credit, overdraft, all these facilities. The basic working capital facilities that we have is cash credit and overdraft. As we know, both of these facilities are for funding the working capital gap. That is, we found the working capital gap is, in this case, is 4,000 rupees. This 4,000 rupees, bank will fund around 75%, it will come to 3,000 rupees. So what is the difference between cash credit and overdraft? Cash credit and overdraft both are running facilities, means both are like, they will have a limit, up to that limit they can utilize any amount. Suppose the limit is like 3,000 rupees. We are sanctioned for 3,000 rupees. Customer, based on the requirement, they can utilize from 0 rupees to 3,000 rupees, and they need not pay this amount. There is a specific repayment date. So there is a specific repayment date, means whether they need to repay. Yes, they need to repay. How it is monitored? This is like a normal running account, meaning they will have normal daily transactions in this cash credit or overdraft account. So in this account, normal purchase and sales happen regularly. So there is normal customer money coming into the account, money going out of the account. We have to ensure that the total outstanding does not cross rupees 3,000 in these accounts. That is the normal rule that is being followed. Suppose I will give an example. Very simple example I'll give. On day 1, customer purchase materials for 3,000 rupees. But they did not pay any amount, so let the outstanding be 0. On day 5, they need to pay the amount. Say like they paid 5,000 rupees. They paid 5,000 rupees. So the outstanding is transaction outstanding. Outstanding is how much? First day it will be 0, second day it will be 5,000 rupees. Next day, say they are processing the materials, they sell the goods. Say like on 7th day, 6th day, they sold the goods on credit. Mean they sold the goods, but by customers will pay us the money after 2 days. So on the sale day, there is no money. There is no money coming into. So the outstanding remains same at 5,000 rupees. On 8th day, money comes from the customer. Some portion of goods only sold. So they will get some portion of money only. They get money for say like 3,000 rupees. So the outstanding goes from 5,000 minus 5,000 to, oh my mistake, minus 5,000 to minus 2,000 because 3,000 rupees has come. Now again on day 10, they purchase goods for here by now itself the outstanding amount is already crossing 5,000. So this is possible only if the limit is 5,000. If the limit is 3,000, then this transaction itself is not possible. So this is like running account where normal transaction continuously happens. Like money coming in, money going out continuously happens. And this is the basic concept of an overdraft facility. Meaning regular money coming in will happen, money going out will happen. But we have to ensure the outstanding will always be within the limit. That is this 5,000 rupees. Oh my God. Yes. Outstanding is within this 5,000 rupees. So next day when they want to purchase for some 8,000 rupees, then the bank will not allow this transaction. Bank will stop because if this transaction happens, total outstanding will go to 10,000 rupees. So bank will, what will do? Bank will return this transaction as inward check return. This transaction will be cancelled, nullified by an check return, and this transaction will be nullified. So that is the basic property of an overdraft facility. Where it is a running account, you can continuously get the money to the account and go the money out of the account. That is the major characteristics of an overdraft and cash credit. So there's a base difference in cash credit and overdraft facility, which I will cover later by another example. Apart from that, there are other facilities like term loan. Term loan I will cover later. There is another two more facility that is mentioned here. That is working capital term loan and bill discounting. Working capital term loan and bill discounting both are working capital facility. First, I will cover bill discounting. Bill discounting is like when you sell the materials, you will most probably get an invoice from the customer. If the customers are reputed, they may issue a bill of exchange. This bill of exchange, based on the comfort of this bill of exchange, bank will give the money after reducing interest. This also I will give an example. Suppose customer has made, we have sold, suppose I am a manufacturer of, I am a manufacturer of pens. I do job work for, say ITC for classmates pen. So in that situation, I sell say like 10,000 pens to classmates for rupees 8. So I sell 10,000 pens to classmates for rupees per unit is 8. So total will be 80,000 rupees. This I sell for credit period of 30 days. It means what? I will get the money from ITC only after 30 days. So what I do here, I sell classmates pen, ITC classmates pen for 10,000 rupees. So the total price I sell is for 80,000 rupees and I will get a credit period of 30 days. So I'm manufacturer of pens. I'm a job worker who manufacture pen for classmates. Classmates will give the brand name and they will sell later. So I sell to classmates for 80,000 rupees. Since ITC, who is the owner of this classmates brand, is a reputed company, if we get a bill of exchange from classmates, bank will discount it. Bank will discount these bills. Whether bank will pay full amount of 80,000 rupees? No. Say like since the credit period is 30 days, they will deduct interest. Interest of interest for 30 days. They will introduce interest for 30 days. So that is say like interest is 8%. So what they will do, they will compute 80,000. That is the value of sale. On that they will compute 8% interest. This they will compute only for 30 days because after 30 days banks will get the money. So they will calculate interest for 30 divided by 365, which is equal to 526 rupees. So banks will pay to customer after reducing the interest amount. So banks will pay upfront 79,473 rupees. And the balance will be deducted by the bank upfront. And when the bank gets money from ITC, they will get full amount. And this difference of 526 rupees will be the bank's interest, which they will get. So bank will earn interest of 526.02 rupees. This is a simple transaction where bill discounting is being done. So I will repeat this example. Suppose I as a job worker manufacture pen of 10,000 rupees, 10,000 units for rupees 8 per unit. I will get ideally 80,000 rupees if I sell on cash. But ITC will not sell on cash. ITC will tell that I will not pay you now. I will pay you after 30 days only. In that situation, if I want money upfront, I will approach bank with this invoice and I will get a bill discount. I will get a bill of exchange from ITC. This bill I will submit to bank. Bank will give me the money. Bank will give full money. No, they will reduce interest. Bank will reduce interest of 8%, 8 by 100, and that too only for they will calculate only for credit period. The credit period is 30 days. Credit period is 30 days. So that's why 30 by 365 they do. So interest of 526.02 rupees they will reduce and the balance money will be paid to the custom. The balance money will be paid to me. So this is a simple example of bill discounting. Okay. Apart from that, there is another important facility, working capital term loan and term loans. Both are same. In only end use is difference. Working capital term loan is term loan for working capital. Term loan, general rupee term loan is term loan for capex purpose, means term loan for long-term purpose. So there is a equal principal repayment, a normal structure that they have to pay. They have to pay every month a portion of principal and a portion of interest. There are two methods, an EMI method and equal principal repayment method, which all I will give an example of one of this method. Suppose entity is taking one, I am running, say like I'm, same example I'm taking, I'm job worker for manufacture of pen. I need to buy a new machinery. Machinery cost 1 lakh rupees. For this 1 lakh rupees, I need to take a loan. I am taking loan for say like tenure of 7 years. 7 years is nothing but 84 months. So for this 84 months, I will have a repayment schedule. Month opening balance principal repayment, interest, and closing balance. So month, select first month name. My principal will be 1 lakh rupees. Whether I need to pay every month equal principal. Meaning on this 1 lakh I divided by, we have 7 years, means 84 months, divided by 84. So that will be 1190.47. This is equal principal that I need to pay every month. Apart from that, I need to pay every month some interest also. So what is interest rate? Interest is equal to 8%. So that is equal to 1 lakh into 8 divided by 100. That is interest. And this is for a month. So every time we have to calculate by 330 by, say like 1 by 12. 1 by 12. Because we have 12 months. On that first 1 month interest we are calculating. So the closing balance shall be opening balance minus principal. This will continue for second month, third month up to 84 months or 7 years. Eight two, 83, 84. Same principal repayment I will pay every month. Interest will be calculated per month only. So opening principal, that is opening principal into 8%, 8 by 100 into 1 by 12. That will be interest. And the closing value will be same. That is equal to opening balance minus principal repayment. This I will I'll make a schedule for entire month. So by the year at end of the period, the outstanding will be nil. So this is the simple example of a repayment schedule for a term loan. This will be same for working capital term loan or capex term loan. So this is a simple example of a term loan repayment schedule. Now I need to cover two facilities which is called as non-fund based facilities. Non-fund based facilities I will cover in next video. I hope this video will be useful for your upcoming CA intermediate examination. If you like this video, please like and subscribe. Thank you all, and if you have any queries, please do comment in the comment section. Thank you.